Okay, so we are recording. Move that to the bottom. So I want this to be interactive. Please ask questions if you're kind of new to investing or you haven't done investing, or even if you're experienced, you have questions, just feel free to go ahead and take yourself off mute. You can do that by using your space bar. So we're going to talk about taking hold of your financial future and investing in real estate. I think some of us on the call are actually in real estate. So I always think as a trusted real estate advisor, you really should have some experience in real estate or investing in real estate yourself. So I always train my agents and people in my brokerage or on my team to really start thinking about that. Or if they're already investing, like how can we help build your net worth by adding more to your portfolio? And that can be many different ways of investing. It could be commercial, it could be residential. So we're just kind of going to walk through some of that. And then just a little bit about me in case you're not familiar with my background. I have 16 years of real estate experience. I've been a broker for 14 years, and I own a local Keller Williams franchise here in Sarasota, Florida. And I'm an accredited buyer representative, a certified luxury home marketing specialist, a certified international property specialist, a certified residential specialist, a resort and second home property specialist, and a transnational referral certified agent. Okay, so those are just some of the designations and education and background do I have. So I'm going to ask you a question. What do you want to learn today? Is there something in particular that you feel is important to build your portfolio, or is there something important you would like to know about how to interact with your clients even?
I always hear ratios, I guess, thrown out there about I want to make sure I have, I make a certain amount of profit. What is the typical amount and how do you determine that?
Okay, yeah, we're definitely going to walk through that. And Austin, I know that's a really good question for you too. You love talking about this stuff. You really lit up yesterday when we started getting into talking about commercial property and cap rates and return on investment. So definitely don't be shy. I know you're not shy. I'd love for you to pipe in with all your excellent experience. Everyone can learn from you as well. Anyone else have anything particular they would like to learn today? Okay, I guess it's just going to be you, Carrie. You're learning everything.
It's the same for me. What makes something a good investment property and how to determine which one would be a good investment as opposed to another, and all the other ones that are listed.
Okay, wonderful. All right, so that was Bria. If I'm not sure if everyone can see everyone. I'm trying to do it where we can still see the PowerPoint.
I could see everyone in the PowerPoint.
Oh, you can. Okay.
Well.
I just like seeing your faces as I'm talking, but I might move you around a little bit just so we don't cover the PowerPoint. Because I remember one time when we did this, it like took up the whole screen. It was like, no one can see it if we record it. So we're going to talk about there's two options. And this is specific to real estate investing. You can buy for cash and you can find and refer, or you can flip. And then number two, you can buy for cash flow and equity buildup. And then you have lease option, buy and hold, buy and improve and hold, which we're going to talk about holding real estate a lot. These are a couple of books that you can get on kellerinc.com, and it's INK, kellerinc.com, or you can go to Amazon. Gary Keller and a couple of other people were involved in writing these books. I think there's an echo for some reason. Millionaire Real Estate Investor. And there's also Hold, which is how to find, buy, and rent houses for wealth. I have a lot of other books I'm happy to share with you. These are just two books that this PowerPoint was based on. So it'll kind of give you a little bit more reading after we go through the PowerPoint. They're, again, on most sites, Amazon, you can also get them ordered from, but there's some resources on kellerinc.com. So there's 11 steps to build wealth through real estate investing. First, you want to learn to track your net worth. Well, first establish your why. So Megan, you and I have talked about this a lot. I think you jumped on. You really want to establish your why for building wealth through investing. So I want you to kind of think about that as we're rolling through this PowerPoint. Like, why do you want to invest? What is that money going to do for your family? Or what is it going to do for your business or a loved one maybe? Or what is it going to do for your future? So number 2, you want to budget like a millionaire. And number 3, this is probably the most important thing on this entire path, going through these 11 steps, steps 1 through 11. The 11 steps to building wealth, really it's hard to get to step number 4 if you don't start tracking your net worth. So just be honest, how many of you are tracking your net worth on a monthly basis?
I am, although it's very new.
Okay. And you started doing this when, Megan? When did you start tracking your net worth?
Probably in November-ish when I started actually doing a profit and loss statement every month. And certainly now that we are involved with Dave Ramsey and becoming ELPs, just refocusing in on his philosophies, plus Ben Kenny's philosophies. We have so many people, and of course you yourself, listening to your path and the path of money. It's very inspiring, and I know that it's really important to track these things and to be hardcore, especially in the beginning, and reducing your debt so that you can build a legacy worth living and have a life worth living.
Sorry, there was a fire truck going by. Our office in Venice is right next to the fire station, so it's good and it's bad sometimes. So hopefully everything's okay out there. But I do like to track my net worth, and I will tell you that a lot of people were afraid to do this, especially when COVID started, because they were kind of scared to look at it like, well, how much do I have in reserves? But I will tell you, we had a lot in reserves and we were able to keep all of our people. And I was also still able to continue investing and also looking at future investments. And my net worth actually increased significantly during a pandemic. So it's really what we want. I mean, obviously, we don't want to brag about that. We don't want to put that in front of people that aren't doing well during the pandemic. We want to help them. We want to help them sell their house if they need to get into a smaller one, or we want to help them do a short sell if maybe they're not able to make their mortgage payment. There's a lot of people that have renters not paying. There's a lot going on right now. So our job as a real estate advisor is to consult and educate with our clients. And that might be helping them in a time that they're not doing so well, even though real estate is. So we have to be very careful of that and how we speak with our clients. But we also want to put them in the position to next time, something like this does happen, that they're in a position where they do have reserves. And so if they lose their job, their job, they have other lines of income. And hopefully that might be a line of income coming in from cash flowing properties, which we're going to talk about today. So I'm going to share with you a way to track your net worth. So let me pull up a spreadsheet. And hopefully, I'm going to stop sharing and I'll go back to this PowerPoint in a minute. Hopefully, you'll like this net worth tracker. It's really simple. So if you've never tracked your net worth, this is really easy to do. Okay, so this is it. It's really plug and play. I mean, it tells you exactly what to do. It's a spreadsheet in Excel. It's all set up for you. Here's the next tab. You just go down to the bottom. So once you start doing this, it'll tell you what your net worth is based on your total assets and your debt, right? So you have cash, your assets, your investments, retirement accounts if you have them. Hopefully you do. If not, let's start thinking about how you want to build those retirement accounts. And then you have your debt, which you want to obviously get rid of. That's the idea. That's how you increase your net worth. So that would be consumer finance, student loan, mortgage, and car finance. So I know that on my team, we are now considered endorsed lender providers, or local providers, with Dave Ramsey. And if you haven't gone through that training before, either as a consumer or a real estate agent, it's really great training. If you're on my team and you're on this call, please definitely finish the training. It helps you kind of connect with the people that will be referred to us, and we can speak the same language because you've gone through that same training. A lot of that training talks about how to get rid of your debt, just going through that step. And then your assets, you're going to fill this out. Obviously, what you have in the bank, your checking, your savings, reserves, right? We should always have at least 6 months of reserves. Then you'll have your assets listed. So what would an asset be? What do we sell every single day?
Real estate, baby.
Yeah, I love real estate. So you have that value. And so how would you determine the value of those assets?
Well, we're realtors, so I hope that we know the fair market value of the real estate that we own and that we are tracking that, because if we're buying smart, it should be increasing in value.
Yeah, so a lot of agents will come to me and they'll say, how do I do a comparative market analysis, right? And that's how you're coming up with your opinion of the value. And market value is what someone's willing to pay at a given time, right? But as brokers, people want our opinion. I had a client today sitting at this very same desk spending up over $1 million potentially. And so this is really, really important for him. He's moving his entire family across the country during a pandemic. Grateful he can do that, right? And work from home, and he owns his own business and all these wonderful things with small children. How awesome is it that we even found a couple of homes to actually evaluate with such low inventory? But they always want your opinion, and you need to know how to evaluate a property. And the more time you're in the business, the more experience you get. But what can you do on a daily basis if you're new to the industry to really fine tune your skills on being able to evaluate properties, so that when you want to invest even on yourself, you know how to determine what something's worth?
So, Brandy, a great way to do that, and something that I've done, is looking at that home page on our MLS. We can see the new pending solds, and also look at the expireds. Look at what's not selling and why it didn't sell. Sometimes it's a marketing issue, and sometimes it's a pricing issue. So when you start looking at that and you're looking at it every single day, eventually get to the point where you have gut instincts about things. When something comes on the market, you're like, oh, I know this area. Oh my gosh, that's an incredible deal. Or,
Yeah.
oh, that seems high for the area. I wonder, why is this price so high? Did they do elaborate finishes and put a lot of upgrades into something?
Yeah, and you can also, let's say you have no listings yet. Let's just pretend you're new to this because we have so many people on the call today. Let's just say you have zero experience. How you can practice is choosing someone's house. Maybe pick your parents' house, or maybe pick someone you know's house in the local area, and you just say, okay, if I had to sell my loved one's house, my grandmother, my mother, someone close to me, and I had to get a value out of this, and I need to determine the value of the home in order to put it on the market, practice. So you're going to pull the active, pending, and sold, right? And you're going to put the criteria into the MLS, and you're going to go back. Really, you don't want to go back too far, especially right now, but no more than a couple of months. 1 month is a lifetime right now. But should you have to go back further than that, you can. And you're going to look at things like the price per square foot, and then you're going to make adjustments based on certain features of the home. Now, how do you know if one feature is better than the other?
Well, that's a great question. Fortunately, we have some wonderful vendor partners who have shared some worksheets with us that give us an idea for what those things are worth. And you can also, if you don't have a worksheet like that, you can look at homes like, oh, well, all the homes without pools sold around this price, and all the homes with pools sold for this much more. And then you get an idea for what those average values are.
Yeah. And I know a lot of agents say, well, I'm not a numbers person, I'm a people person. You are a numbers person, you just don't know it. And I promise you, it's second grade math. It's not hard. We're going to walk through some of that today. So just practice doing comparative market analysis. There's classes on it at Stellar. There's also great lender providers and appraisal classes with mortgage brokers that offer them for continuing education. And then just practice. People always say, how come you're so good at doing CMAs? Or how can you just know off the top of the head a value? Like, I knew by looking at these 2 MLS sheets, when the client was sitting in front of me, just looking at the sheets, whether or not they were overpriced, underpriced, or within a specific percentage of where they should be. You're only going to get that experience if you practice all the time, even if you don't have listings. So don't worry if you don't have listings or buyers yet. Most of you do, but just that's the way you can practice. So anyway, you can move on to investments over here. So that can be many different things. So Austin, what would be an example of an investment?
Well,
Maybe
you have the
even
obvious. Well,
yeah,
you have
properties and what else?
you have stocks and things like that.
Mhm.
You know, you have. I assume you would classify real estate investment properties that fall in that category or assets.
Yeah, so a business could be an asset, a real estate investment property could be an investment. You could also have, let's just say you lend hard money, right? So maybe you have someone paying you interest on that. There's all these different ways that you can categorize things. Retirement accounts will be the last one here. And then you have your debts, right? I think we know what debt is. We don't really need to go through this. All the stuff you don't want to pay every single month, like your car if you have a payment. Hopefully you don't, but some people do. You know, we live in the United States. We like to have pretty things and shiny objects, and we like to take out loans, right? So you have medical bills sometimes, consumer finance, that might be some credit cards. You have a mortgage on your property. If you have your property free and clear, congratulations, you do not have any debt. And then this last sheet's going to show your progress, your net worth, and then your change. So this will show you how you're actually gradually increasing your net worth. And then again, this page on the front will show you that dollar amount. So when you log in every single month, you can see, did it go up? Did it go down? All right, so if you'd like that worksheet, I'd love to send it to you. It's a great worksheet to send to your clients too. So let's go back to the PowerPoint. So that's how I track my net worth. And I do this, like I said, every single month. And then we want to understand the language of real estate. We have a lot of acronyms. Things get really kind of easy for us on the day-to-day, but a lot of times when people are just starting to invest, they don't know the language. So we'll go through that quickly. You want to avoid the pitfalls of investing. Then you want to build a team. And I don't mean a real estate team. I mean a team of trusted people outside of real estate to help consult. They could be in related industries like CPA attorney. And then you want to confirm your investment criteria. So really strong investors, experienced investors, they have a specific criteria they like to stick to. And then you want to practice analyzing deals, just like we discussed, but from an investment perspective versus, you know, I'm going to list it on the open market as an MLS listing. And then lead generate for investment prospects, finance and buy your investment property, and then manage like a pro. Okay, so we kind of talked about retirement a little bit when we were discussing net worth. So you want to have a retirement reality check. So I'm going to ask you a couple of questions, and these are questions that you can also talk to your clients about because you want to figure out how you can help them increase their family's net worth so that they have a really great retirement, and real estate's a part of that. Do you know what you need to retire? So I want you to right now write down or think about a number. I like to write things down. So just take a second and write down what you think you would need to retire. And then the second question is, are you on track to meet those goals? And be honest with yourself. If you're not, great. That's why you're here, and we're going to help you with that. If you are on track, even better, you're going to just continue to increase your goals, I hope, and have a much better retirement every single year as you add to that fund. Okay. So these are just 3 different age groups, and it's regarding your annual retirement goals. So let's just say you have an annual retirement goal of $100,000 and you started saving $100 a month at age 20. Now we have all different age groups probably on this call. So you could start at a very young age, and at 64 years to achieve that goal, you can retire at 84. Okay, saving that $100 a month at that age. So let's just say maybe you're 30. Maybe there's a different amount that you have to save. So it could be $500 per month at age 30, 52 years to achieve the goal. You can retire at 84. I don't really want to work this long, and I don't want to wait to retire at this age. So I can tell you, this is a different plan for me, but I want you to start thinking about what that looks like for you and how much you can put away each month. So let's say you started saving at age 40, you might have to save a lot more, right? You're going to need $2,000 a month for 25 years to achieve a retirement age of 65 years of age. Okay, so did those numbers make sense? Pretty simple, right? Okay, so if you were to follow 100 people from the start of their career for 40 years, what would you find? So you have 1 would be wealthy, 4 would be financially secure, 5 would be working, unfortunately 36 would be deceased, and 54 would be broke. So what do you think about that? I'm going to put your lovely faces back up here so I can see you better. What do you think about that?
It's heartbreaking because we just don't teach people about financial, aptitude or how to achieve wealth. And we have such incredible opportunities here in the United States.
Mhm.
People
And
can start
we're the
business.
drivers too, right, Megan? So we can educate people of all walks of life, of all ages. And we have a really good opportunity with Keller Williams. And I know you want to be a quantum leap instructor, and there might be other people on here that might be with Keller Williams that are considering that. It's a huge opportunity to teach young adults between the ages of 18 and 24 how to really understand money and what their big why is, and how they can plan for their future.
Yeah, it's really important.
Okay, so that's how we can kind of give back, right? Teaching those young adults. So here's a case study. Jimmy and Linda McKissick, they were involved with writing the whole book that I mentioned earlier. They're also Keller Williams agents. They're out of production. I believe they're in the process of selling their team for around, I think 1.5, I think she said. Maybe I'm wrong. I hate to misquote her, but I believe that was the number. So your business, your real estate business is also an asset, believe it or not. So in 1991, they had $600,000 in debt. What do you think that number would be today? I mean, it's 2020. This was a long time ago, almost 30 years ago. What do you think that debt number would be today?
$1 million? I'm just
Maybe.
guessing.
Yeah. So it would be more, right? In 1991, they were in debt, like I said, $600,000, and they share this story. You may or may not have seen them up on stage at family reunion or other conferences with Keller Williams. They decided to partner with the builder. They located the property. He put up all the money. He did the repairs. They flipped it for a $15,000 profit, which today would be obviously more money. Invested profit in another deal. So now, well, actually, even in 2003, we'll have to see what they say this year, what their net worth is. They gained a net worth from 1991 to 2003 of $10 million. So they started out with 600,000 in debt, and they increased their net worth to $10 million in a very short time, right? Didn't take them long. So at that point in 2003, they had 48 single family homes, 1 fourplex, 1 duplex, 1 small complex, 1 commercial space, and 1 residential development. Do you think they might own a little bit more real estate today in 2020?
Definitely.
Yeah, and now wait, even more 2021, right? They're already like moving. It's to probably have a plan each month to look at investment properties throughout the year this year. So it's just going to keep getting better and better. Okay, so I want you to look at this and I want you to interact with me. Tell me after you look at this screen what you think. And when you're ready, just speak up and then I'll open up the video a little bit so I can see you talking.
Ready.
All right, I'll give it just a minute or 2 more, Megan, so everyone else can kind of take a look.
No problem. I've seen this before, in all fairness.
Yes, 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 yes.
There's your investment category.
What'd you say, Austin?
There's your investments category.
Yeah, and so what do you think about the different categories, like overall, big picture? What does this kind of look like to you?
Looks like the best investment would be real estate.
And why is that?
Because you can buy more for less. Because obviously you can leverage the mortgage market or the mortgage to your advantage. So you only have to put down your 20% and be able to finance $100,000, and you have the asset. Then you can also be making money off the asset from the rents that you collect, and then then you can put that money towards paying the mortgage down, and then obviously doing it all over again with a new property. While
Yeah.
all the other investments, you got to fork up the whole 100,000 right out the gate.
Yeah, or even more, right? Because 100,000, even for an investment property, like that's not much, right? So, gosh, we're lucky to find that in our area. If we do, it's probably lots of offers, and or there's something really wrong with it. We got to pour some money into it, or we got to invest outside of our specific area. So, I think the concept itself is what Austin is saying. You have less money invested up front, but you do have look at the adjusted ROI, right? The rate of return here. What does that tell you?
You get a much better payoff from a real estate property than you would any of the others.
I mean, where else do you earn that kind of return?
Right. And then we'll break down the adjusted rate of return. So Carrie, you'll be able to understand when people are saying, I want X amount of, return, whatever they're saying or they're asking you. And then you have that 5% appreciation. So not only do you have a higher adjusted rate of return, ROI, you also have appreciation, an asset that's appreciating. And then if you rent it out, you have a tenant paying down your debt and less money up front.
I do have one question for you. Under the potential loss for 40%, can you explain that?
Yeah, so you'll see as we go through the slides, I think they talk about it in the next one. If not, we'll come back to that. But it's less loss though, if you look across, right? So what do you see the potential losses for stocks and mutual funds?
You have a chance of losing all of it, 100%.
And that's why I don't like the
Terrifying.
stock market.
I'm risk averse.
I'd rather have millions of dollars in real estate. And this is just me because it's what I know. I'm not saying it's wrong or right. But for me, what this tells me with simple math and logic is I could lose millions of dollars in the stock market, but I don't have the same potential to lose 100% of that in real estate. So over the studies, they're showing that there's a 40% potential loss with real estate. Now, why would you have that potential?
I mean, markets change. So, there is a chance that your property is going to be worth less at a specific point in time than when you purchased it. However, the studies show us that over time, real estate always increases in value over time.
Long periods of time, right? Over 100-year history.
Yeah,
Austin,
if it crashes and you need the money now and you have to sell, no other option, you can't wait for it to bounce back, then you just lost, you're going to lose 40%.
Yeah. So people have that fear, right? When the market crashed before. But what if those people were in the position to hold their real estate, like Megan said?
They should bounce back. They really shouldn't. It should be 40%. It should only be, if it's even down market, it still would only be maybe 5%.
Yeah. So when people say, well, there's risk in real estate too. Yes, right. There's risk with every investment. That's just part of investing. So if you just don't want any risk, I mean, that's okay too, right? Just have your primary residence, but you're still risking that, right? You're risking the loss of the house of your head. But the reality is, if you're looking at it for a long term or a longer period of time, you can see the risk is less, in my opinion, and on the studies.
And the other thing that we've talked about, like, let's say you own multiple properties. Well, you can always, if you're living in a larger, more expensive home, you can always rent that out to cover the cost, and you can move into your smaller home, which you turned into a rental. So there are lots of ways to protect yourself, especially if you have a real estate advisor to help you walk you through those options.
I love that, Megan. Okay, so we're going to move on. I mean, you're such a good class here. I love it. You know what you're doing. You must be a trusted advisors out there. All right. So this is, again, retirement reality check example for a property over 16 years. So we're talking obviously a longer period of time. I'm not a big flipper, but there's money to be made in that, less and less nowadays. But listen, if you like to flip, that's great. It's just not my thing. We'll touch on a little bit of that, but mine is really about holding for a specific amount of time. But if I see equity and there's a high of a market, like right now, I'm willing to sell my investment properties. I just sold one and I only owned it 2 years. So doesn't mean I'm always holding them for a long period of time, but you make the decision based on what you see in the market. And if you're, studying the market every single day, you know when to time it. Purchase price in 1988. This is just an example, so don't laugh at me when I'm using a $72,000 property. Don't laugh me off camera here. But let's just say in 1988, you were able to purchase a $72,000 property with a down payment of 20%, like Austin said, less money down than if you had to take $72,000 or the total, right? Whatever you're paying for, say $100,000 to put into real estate. So let's say 20% of this specific property is 14,000. Your mortgage loan amount was 80% of the total, which is 57.6. And then you have two options, right? You have a 30-year mortgage option or a 15-year. So you can see in 30-year the difference, the 34,545, and then 15 it would be 18,327 total net cash flow. And then again, total equity built. You can see the difference there because of the period of time. And then your total return. And then you can see the annual rate of return below that. So does that all make sense to you based on the example used to the left?
It sure does.
Okay, awesome. We'll move on. Okay, so going back to your why, we really want you to kind of think about, why are you investing? So why do you want to pursue financial wealth by investing in real estate? What is your motivation? I want you to think about it. Take just a few seconds and write down why you want to have this cash flowing or mailbox money, sometimes people say, right? When you have investment properties. So if you want to speak up about it, great. If not, just write it down. If anyone wants to volunteer what their why is or their motivation, feel free to share.
So I'll share with you, Brandy, just
Okay.
because we've talked about this a few times.
Yeah.
But, my motivation is to build a legacy worth leaving, for my family. Just want to leave something for them. And I also am really passionate about giving back to my community. I mean, it's kind of selfish in a sense, because when you're the giver, it blesses you almost more than the people you're giving to.
Yeah.
And that's really important to me. I think that we have a duty to those that are less fortunate around us. And, there are a few causes that I'm really passionate about. So, if I can have passive income and build wealth through investing in real estate, which is what I know about, I mean, it makes my world and those around me world much better.
I love it. Anyone else have anything to share about their big why or what their motivation might be? What gets you excited about thinking about this, even if you haven't invested?
I have watched my in-laws invest in property and do really well in retirement. And then I've watched my family not do well in investing. And now it's, with COVID and stuff, the jobs that they did have, they've lost. And so now they're kind of struggling a little bit. So I don't want to be in that position, and I don't want my children to watch us be in that position down the road either.
I love it. Thank you for sharing, Carrie. I love that you have those two examples, and you have something to look at and go, wow, I can see how this works and I can see how it doesn't work. And I certainly want it to work for me and my family. Okay, anyone else want to share? All right, you're all being shy. We'll move on. Okay, so maybe this will excite you. Maybe you don't want to share your why, but maybe you'll share your financial number with everyone. So what is your financial freedom number? Do you have an idea of what that looks like? Maybe you don't know your why yet, and that's okay, because sometimes that takes some time. And as you get older, I will tell you, it becomes a little bit more clear, because you're like, I'm running out of time. And it's usually, your legacy or giving back or something kind of triggers you to think about it. And it's the experience you usually have in your life. So does anyone want to share, like, what would make them happy? What would be their financial freedom number? No one wants to talk about it? All right, we'll write it down. You don't have to share if you don't want to. But I really want you to think about having a goal for that so that you have something to look forward to and track. Okay, so let's go back to Linda and Jimmy McKissick. So this was their goal. And so this might give you an idea if you don't have a financial freedom number or you're not really sure what to work towards. This was their goal. Quit working in, 20 years, 20,000 per month in passive income. Achievement strategy. Buy 20 single family rentals, each generate 1,000 cash flow per month, complete purchases in 5 years, finance on a 15-year note, and put at least 20% down. So they got started a little bit later. So that's why I think they're doing that 15-year note. And then some people just choose to. And they wanted to really get that $1,000 per month per property quickly. So yours might be different. It might be $500 per month with 20 homes. It might be 10 homes. It might be 5, whatever your number looks like. This is just an example. Okay, is that a good example for everyone to kind of get an idea of what to work towards?
Yeah, that's awesome.
Great. All right, so now we're gonna talk about fun stuff, budgeting. You guys probably are gonna hate this section. Most people hate this section. I know my young adults are like, what? Budget when I teach Quantum Leap. I don't want a budget. Don't put me on a budget. I like my Starbucks. I hear that a lot. All right, so let's just say you have $5,000. What are you gonna do with it? Spend it, save it, invest it, donate it. Those are your options, right? Okay, so this is one of my favorite slides. So if nothing else, you take a picture of this. This is basically understanding the path of money. So do you work for money or does money work for you? Which one would you rather have? Do you want to have to always work for money or do you want money working for you?
I want money working for me.
Me too. It's more fun. I promise you. All right, so 2 kinds of capital. We have human capital over here, number 1. And you work for the money, and then you have capital assets. Your money works for you. And those both can lead to cash flow, right? Whether you're working for it or whether it's a capital asset. And then there's 4 choices for cash flow. Spend it, donate it, save it, or invest it, okay? And then you have 2 basic investment choices. You can lend or you can own. So what does that mean? There's 2 basic positions. You have passive income and you have active income. So what are the differences? What would that mean? So passive income is lending. That would be money markets, CDs, bonds, T-bills, and it would be stocks, okay, REITs, or mutual funds. So I'm not a big fan of everything to the left, like at a high percentage as far as a portion of my portfolio, because I'm a control freak. So maybe your personality is different, but I like to control my money. I really want to be in control of it. Then over here, you have active. So you can lend money like owner financing, okay, hard money. You can do private lending. You can own businesses. I like owning businesses, and then you can own real estate. So I really like this active section over here. And when I teach young adults in Quantum Leap, I'm really trying to open their mind, or I intend to open their mind to this part of the possibilities with money. Okay. And that leads to financial returns. The passive or active both lead to financial returns. It's just the 2 differences are they control it or you control it. So which one stands out to you? Which one will you prefer? I mean, either one, you're going to get a financial return, right? Trying to see who else is on here. It's not speaking up. We've got lots of people on here being shy. I know it's late in the day. You all worked hard to find properties that are probably not available. You have to search for off-market stuff. I know. Have a cup of coffee. Come on, let's chat. Hopefully you want to control your own money. I hope that's what you're thinking. Okay. So you're going to budget like a millionaire. You're going to build habits to develop a financial wealthy matrix. And this is an example of the financially poor money matrix in action. And then this is an example of a financially wealthy money matrix in action that is a little different than the top slide. So I'm sure you can see something different in that diagram. What stands out to you?
I mean, it obviously diverts the cash to the capital.
Yeah. So which one's better?
The bottom.
Bottom one, right? So that's
Maybe.
kind of in your mind, like what you want to see happening. All right, so then you're going to budget like a millionaire, examine your budget. How does your required spending compare to your discretionary spending? So I want you to think about this. Is your required spending higher than your discretionary, or is it the other way around? And how can you make those adjustments? So you can examine your budget, okay? And you can look at the discretionary spending. What does that look like? Do you have a lot of fun and very little savings and very little investing? Or do you have a lot of investing and a lot of savings, which helps you create your fun? How is that? What does that balance look like? And it's great if you want to have a lot of fun, just don't expect to retire young, and just don't expect to have a lot of savings and investing if you're starting out with debt now. Now, if you're not starting out with any debt, you can kind of have a lot of fun and save and invest at the same time. But if you have some debt, we have to make some sacrifices on the fun to kind of get there. And it seems boring, and it seems like, oh, so-and-so on Instagram or Facebook's out there vacationing, doing way more fun stuff. You have to sacrifice in the beginning if you have the debt, right? You got to get rid of that.
It's a short-term pain for long-term gain.
Yeah, exactly. And then you can go have all that fun you want, right? Because then you're going to have savings, investment, and fun, which is pretty awesome. Now, what do you think the difference is between the budgets of millionaires, investors, and consumers? What does that look like? So over here are the millionaire's investor budget. So you can see at the bottom, it kind of gives you a guide. You have investment spending, income taxes, required spending, and discretionary spending. All right. Then you have the millionaire investor's budget priorities. Okay. And you can see the differences there. And they invest pre-tax, they invest post-tax, and they invest anything left over. So they're always investing. Okay. So start budgeting like a millionaire. Figure out where your net spendable income goes each month. Hopefully that net worth tracker helps you do that. One thing you can do is, I love Ben Kenny's Win, Make, Give wealth building series. He has a podcast. He's on YouTube and Facebook. And he actually has a whole section on how to print out your bank statements, your debit card, your credit cards, and highlight. And he tells you how to highlight them differently so you can figure out what do you really need to get rid of so you can actually go and invest and also have some fun. Then you're going to separate your spending into required and discretionary categories. You can highlight those bank statements like he tells you. Set up separate accounts to manage required versus discretionary spending. So just if you do nothing else after this, but set up those separate accounts, you're one step further to becoming a millionaire. All right, so start saving. So you want to explore ways to reduce your expenses like we just discussed. Question that discretionary spending. Consider ways to increase your income. Automatically deduct 15% from your income to save for investing. So I have a hard time getting realtors to do this. It's so much easier for me to be able to get this with other people, when I coach other people outside of real estate. I think it's because we get these big commission checks and we're like, this is great. I'm just going to go have a lot of fun with it. I'm going to buy some, a nice car or some sports car or some really fancy car, or I'm going to dress really cool every day. And that's awesome if you already have been saving, but let's start saving 15% before you go buy these things you really don't need. And you can set up a separate investment savings account. So first, you're going to have a discretionary account, and you're going to have that required spending account. And then eventually, when you're starting to deduct that 15% from your total income to save, you can put it in an investment account. And then when that investment account hits a certain amount, like for instance, I coach a team, and the rainmaker for the team says, when I get to 6 figures in that account, that's when I know I'm going to go buy another property. So that's what he feels comfortable with. So figure out what that is. Now, obviously, we talked about tracking your net worth. So we're going to touch a little bit on that. This is the difference between a homeowner's net worth and a renter's net worth. So if you don't own a home yet, this should definitely be a goal, right? It's pretty cut and dry on here what that looks like. So the impact of real estate ownership on net worth is very clear. So if you are an agent or trusted real estate advisor on this call, this is really important to be able to show to a client. If you do nothing else but take this slide out of your PowerPoint and show a renter this. We talk a lot about this at our first time home buyer seminar, because we want them to increase their net worth. Our mission on our team and our brokerage is to increase as many families' net worth as possible, so then they can go ahead and then give back to the community because they have a high net worth. And that's huge. That's a big impact on our community. So from 1998 to 2016, you can see what that looks like based on these studies. And you can see the source at the very bottom. So I'm not making up these numbers. This is from the Federal Reserve, okay? So tell me what that looks like. How does that make you feel when you look at that slide?
Like I want to buy a house.
Right? Do you think that would be helpful when you're talking to someone that really has no interest and they're like, I'm just going to rent?
Absolutely.
I would hope, right? I would hope those numbers would stand out to them. All right, so understand appreciation assets. So which one of these assets do you think are appreciating assets?
Vacation home, personal residence, maybe a 401k.
All right, and your savings account. So you got 3 out of 4, not bad. Not bad, Megan.
Meatloaf would say 2 out of 3 isn't bad.
All right, so this is pretty simple how to, calculate net worth. We did this on the other sheet. If you are kind of presenting to an investor or someone that is trying to get into homeownership and increase their net worth and then get into investing, you can show them this rather than that lengthy net worth tracker. You can always email them that later, but this is a great slide for that, okay? All right, so let's talk about understanding the language of real estate. So profit or loss, purchase price, you have 100,000, purchase price, down payment of 20, loan period 20 years, monthly cash flow 0, the sales price is 100,000. Okay, so when we're talking about understanding the language of real estate is the most able investment. That's why I like it, okay? I actually love it. So it's accessible, appreciable, leverageable, rentable, which I like the rentable part, improvable, deductible, stable, and guess what? You can always move into it. Let's say something happens, the tenant moves out. Maybe you can move into that and rent your other house, right? So you can kind of play this monopoly board. All right. So everyone talks about real estate cycles. Are you getting a lot of questions right now asking like, what's going to happen with the market?
Yes, so many people.
Always.
Yes.
I mean, for the last, 3 years, people are like, the bust is coming. The bust is coming. We're going to wait. We're waiting to buy. Meanwhile, prices continue to go up.
Yeah. So, it's cyclical. So this slide is something you can show a client, right? There are cycles of real estate. And you can see they're usually 10 to 15 years based on history, right? This is what's happened before. So boom, bust, boom, bust. It's nothing new. Okay, so now we can go over and talk about some of the language again. Power of leverage, equity buildup. So ARV, you probably hear this a lot and you're like, what does that mean if you haven't really, been in investing? It's after repair value. Then you have the 1% rule. So a lot of people use this. You divide your monthly rental income by the property value. Does it equal 1%? This cash flow metric is used to quickly analyze an investment property. So that's like a really easy way to kind of calculate. I hope that helps you, Carrie. Cash flow. So what is cash flow? What does it mean if something is cash flowing? Earnings after the cost to own a property. Okay, there's a lot of great books. If you want to read about investing in cash flowing properties, I have so many great books, even outside of what we're sharing today. Then there's NOI, right? You learn this in real estate school, probably forget about it after you take the test, but it's net operating income. It's the profit you're left with after operating expenses are subtracted from the income. And then there's a whole list of what operating income is. I dive a little deeper into this when I teach classes on investing in the Market Center. Then you have ROI. So Carrie, this might be what people are asking you. It's return on investment, the amount of money you make in 1 year divided by the amount of money you initially invested. Okay. So these are really good definitions for you. Then there's cap rate. No one really knows how to calculate a cap rate. I know, Austin, you've had people come to you and like, how do you come up with this?
Cap rate is actually the one that people throw at me.
Okay, gotcha. So the capitalization rate of return for a property if you had paid cash. Okay. We'll get into a little bit more later. House hacking, renting out part of your property to generate income while living in the rest. A lot of people want to do that when they come to Florida. Value add, it's the ability to increase a property's value through prudent efforts. I know you have a lot of experience in that, Austin, and people have asked you like, well, how do you know if that's going to be value add or not? And if you should do it?
Definitely a common question.
Yeah, I bet. Anything you want to add to that value add?
As far as what do you mean?
Like what would be considered an example and like something you've done before? Or how could you better explain that to people if they are still like, I still don't understand what that means?
Well, at the end of the day, every action that we do when we purchase an investment property is what can we do to basically pretty much raise the rent in simple terms, just because that's the easiest thing that you can increase. Typically, what people don't think about is when it comes to renovation, a lot of times people who buy their first home, they really are worried about what the renovation, because that's also an expense. And they're like, well, man, I don't want to put in that kind of expense. I can get someone to rent it right now for X amount of dollars. And they don't realize that if you just come in, maybe do a light renovation, put some new paint on there, maybe some nice countertops, it may cost you 10 grand, but even if you increase the value of the property $100 a month, over 12 months a year, that's $1,200. And if you
Right.
use the cap rate, if you're looking at that, you increase the value by, depending on the market, $17,000, $18,000, it's worth it. Even if it costs you 10 grand, you just made 7 grand profit every single year.
Yeah, absolutely. And so what else does increasing the rent do? It increases that value of the property is basically what Austin's saying. And you're making more money too. You're collecting more money from the rent and you're increasing the property value. All right, emerging market, the area, location, or part of town where growth is occurring and expected to continue, the hot spot. Can you think of an emerging market where you're at, or even in another area where you might be thinking of investing?
Why, yes. Gillespie Park, but even just north of that in the Coconut District, I know
Yeah.
that some of those are opportunity zones and there's some exciting things happening there. And that's in specifically the Sarasota area.
Yeah, and we're going to get into opportunity zones here in a minute. So
Awesome.
you're one step ahead of us. Great job. All right, so obviously you want to confirm your investment criteria. So how to calculate return on investment. So this is the equation here, and then there's an example. So if you had that profit of 500 divided by the 10,000, it's 5% ROI. So pretty simple, right? Now this is a pretty easy example, but it's pretty simple math when you just explain it. Okay, so here's an ROI calculation. So let's just use an example of a purchase price of 100,000 for easy math. This is always easy to use 100,000. Down payment of 20,000. You have a rehab cost of 10,000 and your interest rate is 5%. Well, 5% is kind of high, but depends on how you get your money. Rental income, 14,400. And your mortgage is 5,153.49. Your property taxes are 2,000. Your insurance is 500. Management fee of 1,400. Should you use a management company? I recommend it. It's kind of a headache to manage your own properties, depending on how many you own. Maintenance reserves. Let's say you have 720. You always want reserves, and then you have a vacancy rate of $720. So your annual cash flow is $3,907. So why would you want to have a vacancy rate? What does that mean?
So you're just accounting for the chances that, somebody moves out, it takes you time to get the property back where it needs to be or to rent it out to the next well-qualified person.
Yeah.
And it's always better to budget low, and to factor in those sort of things than budget for, it's always going to be rented.
Right.
To expect those things.
Yeah, I wish that there were no vacancy rates ever, but we're pretty lucky here in Florida because even though we have a lot going on with the pandemic and, some people are obviously not in positions where they can work, people are moving here and they're moving here from other areas and they do rent before they buy. So, you know, we are fortunate and very lucky with our real estate market, especially being in a resort second home market. We have a nice beach. We have the #1 beach according to TripAdvisor, Siesta Key. So we are lucky when it comes to that. Okay, so 13% is your number, just so you know how you figured out this calculation. And that's the breakdown. All right, so understand the language of real estate, today's investor market. So the challenges in today's market would be investment properties are harder to find, right? We have low inventory, fewer available distressed properties, and prices are increasing. So what are the advantages then? Fewer investors are in the market, so you have less competition. Interest rates are really low compared to the past, ever, the lowest I've ever seen. And rents are rapidly increasing. So that's good if you're investing in rental property. And then high demand for rentals like we just discussed. All right, so leverage, one of my favorite words in the entire dictionary. All right, so we're going to talk about the power of leverage and the financial model part 1, equity buildup. So you can kind of see how your equity increases when you own an investment and your debt decreases, right? You got that debt pay down. And then your market value obviously is going up. So lots of equity and you are definitely paying off that debt. And who's paying your debt for you?
The renter.
Yeah. So there you go. Look at that. And eventually you have the market value going up, right? Over a long period of time, you have all this equity, no debt, you own it free and clear, and you have an asset. You have this wonderful investment and you have money coming in. So you have rent appreciation that some people forget about. You have debt payoff and you have cash flow growth. That's what that equals, okay? So you can see you have vacancy and expenses, you have debt service, and you have cash flow, but that cash flow will increase. That's basically what this is trying to tell you. And then eventually that debt service goes away and you have all this cash flow. You're still going to have the vacancy and expenses. All right, so there are unique propositions of investing in real estate in contrast to stocks, mutual funds, and money markets. We kind of already talked about this. Real properties enable investment. Its value never goes to zero. And purchasing property can be leveraged. Love that. So again, we talked about this. Accessible, anyone can buy it. Appreciable, increases in value over time. Rentable, cash flow, cash flow, cash flow. If you get nothing else out of this, just write down cash flow. Making money while you're sleeping. Who wants to make money while they sleep? I do. And I love when I come in and Jessica says, hey, there's a rent check on your desk from a tenant. Yay, they're paying their rent. Improvable, sweat equity. Who's had sweat equity they put in before? I have. I don't like to do it anymore. I like to hire people. But in the beginning, you might be doing a lot of sweat equity, but that's okay. Then you have deductible, depreciable, deferrable. Love the tax benefits. Stable, slow to rise and slow to fall most of the time. And then it's livable. Worst case scenario, you always have shelter in more ways than one. Shelter for you or your family. Maybe the rental market goes, but your family needs a place. You have plenty of shelter. All right, we've already seen this. How they came up with that 25% adjusted rate of return that you see or you saw on the previous slide. It shows you the calculation down here. 25% equals 5% of 100,000 recalculated for the actual $20,000 investment. Okay. And then here's a little slide on that. So leverage, you're using other people's money, banks, mortgage companies, and owner financiers. So maybe it's an owner that does this to make money. Leverage multiplies your profit. So some people don't want to leverage. I like to leverage. You have appreciation or rent are based on total value of the property. So return on investment is calculated by money invested, 20% or 20,000. The calculation is here, not taking rent into consideration, assuming property went up 5%. Okay, we are assuming it went up 5%. Is property going up more than 5% right now? Anybody know what property is going up by?
Isn't it closer to 6 or 8%?
It's definitely higher than 5%. I'll tell you that.
8%.
So everybody's going to have a different opinion on how much the market's gone up, right? And any real estate agent you ask, they're like, it's 8%, it's 10%, it's 30%, it's ah. So we'll talk about that a little bit later, but we're just assuming in this equation that the property value went up by 5%. Okay. So it's a conservative number we're using, in my opinion. Okay. If you stick to your model when buying, this is conservative. So 5%, assuming it went up in a conservative amount of 5% of 100,000 equals $5,000. 5,000 times X percent of 20,000 equals 25%. So to make the money in a mutual fund yielding 10% with no cost, you would need to have $250,000 in cash. So some people say, I don't have $250,000 in cash, but I do have $20,000, or they have something to work towards to save the $20,000. Does that make sense? Okay, I think no one's saying to stop, so I'm going to keep going because we have a little bit more to cover. So what else do you have? You have tax write-offs. Now, there's a little asterisk here because this is going to be recorded and it's also going to be live. I am not a CPA, so it is telling you in this PowerPoint to consult with a CPA or a tax specialist prior to investing. I am not your CPA. This list here is coming from a book that I did not write, but I did read. So Tom Wheelwright is a CPA, and he had written the book Tax-Free Wealth: How to Build Massive Wealth by Permanently Lowering Your Taxes. And he is the tax advisor for Robert Kiyosaki. Has anyone heard of him before? Anyone?
Sorry, couldn't find my unmute button. Rich Dad, Poor Dad.
Yes, Rich Dad, Poor Dad. So if you haven't read that book or any of his other books, those are great books. So this particular book is How to Build Massive Wealth by Permanently Lowering Your Taxes. All right, let's go back. I forgot to mention what they are. So operating expenses, management, leasing, okay, that can be right off. Mortgage interest, financing costs, points paid on the loan, miscellaneous closing costs, fees connected with obtaining the loan. So my CPA, if I buy a property, will say, please send me your settlement statements. Please send me the mortgage interest for the year from your statement, and you can get that online. Share with me what you paid to lease these properties or the management fees. Depreciation, structural value of the property. Capital improvements, new roof, siding, etc. If a new roof's been put on or any sort of improvements, Jessica knows, she probably gets really annoyed. I'm forwarding her like little receipts for the different properties I own to categorize them so he knows how to create some tax benefits for me. And then maintenance expenses, toilets, paint, yard care, things of that nature. I just painted Hillview. So we'll be moving into there soon with one of our offices, and I wanted to paint it. Okay. So this gets a little bit deeper into the tax-free wealth. You can certainly read the book. We'll cruise through this. The government wants to create more jobs and provide affordable housing. Okay, so who creates jobs and provides affordable housing? Who would be able to do that in society?
Well, entrepreneurs would be able to create jobs, and real estate investors can create affordable housing.
Right, exactly. And entrepreneurs receive tax breaks to encourage job creation. So and then real estate investors receive tax breaks to encourage housing. So when people say, well, all these wealthy people, they get so many tax benefits. Why do investors and entrepreneurs have all these tax benefits? Because the government knows that these particular groups of people are going to create jobs, and they're also going to encourage, or they're going to create housing, right? And they're going to create affordable housing for people. Make sense?
Good.
Awesome. So listen, I didn't write the legislation. I didn't write the tax codes, but a lot of it is based on how to receive benefits by owning real estate and buying rental properties. And then this is a breakdown of depreciation on an investment property. A lot of people don't understand how depreciation works. So I'm happy to send you this. There's also a website for this tax-free wealth book, and there's all these PDFs that you can look through. Now, this is the 2018 version, so if anything's changed since then, your CPA will know. But let's say you have a building and it's worth $800,000. So like I own a couple commercial buildings that are right anywhere between $800,000 and $900,000 as far as values, just depending on where they're located. Minus the value of the land. So let's just say the land was $200,000. This is just an example. Your land might be worth more, or your investment land might be worth more, but let's just use this as an example. That equals the value of the building and the contents, 600,000, right? So you have just that minus the land will equal 600,000. So the depreciation of the building, value of the building and its contents is 600,000 minus the contents. Let's say it's 100,000 for the contents. You will multiply the value of the building of the depreciation rate by the depreciation rate in the US on residential property. It'd be 3.6%. So you would take that 500,000 times that 3.6, and that equals your depreciation deduction. Again, get with your CPA. This is just an example. That will be 18,000 as an example. Then you have depreciation of content. So 100,000 times 20% equals your depreciation of $20,000. And then your total depreciation for building and contents is the 18,000 for your building depreciation. The contents of a depreciation of 20,000 is 38,000. Okay, so isn't that awesome? All right. So most residential rental properties depreciate at a rate of 3.636% each year for 27.5 years. Only the value of the building can be depreciated. You cannot depreciate land because it cannot be used up. Commercial buildings and improvements are generally depreciated over 39 years. That's a little different for commercial. I own both. Depreciation means that you can deduct a portion of the building and improvement costs every year over the building's depreciation period. So 1 divided by 39 every year. Okay, so that's something you learn in real estate school, but now you can actually apply it to your own investments. So then there's, again, chart 8 from the book. This is just an example. I'm not a CPA. Tax consequences, cash flow from real estate. Let's say it was 12,000 minus total depreciation deduction of that 38,000 we had earlier, and I showed you how to get there, equals a loss of 26,000. So Pierre's cash flow of 12,000 is entirely tax-free. So the potential tax refund, the amount of the loss that can be used against other income was 26,000 times 40%, providing he's in a 40% tax bracket, which you probably would be if you're investing at this level, equals a potential tax refund of 10,400. Okay, so tax refund. I hope you heard that out loud. Pretty cool, huh? And then these are just some other examples of possible deductions. So you have the left side of the cash flow quadrant, mortgage interest, taxes, charitable donations. The right side of your cash flow quadrant will be business supplies, business equipment, marketing expenses for business, home office, vehicle use for business, meals discussing business, must be discussing business. So always put a little note on your receipt. That's what my tax advisor always told me. So you remember who you had a business meal with. Travel, mortgage interest, property taxes, and charitable donations. So all fun stuff. Now, a lot of people will hire an attorney and a CPA to work together. Sometimes you can find a really cool CPA and attorney. There's local ones here in Sarasota. We'd be happy to give you a list of who our clients use or who we might have used or may have used in the past. But how would you structure it? What's the best form of using an entity for asset protection? This is a little checkbox that Tom Wheelwright came up with. This is what he feels would be best. A trust would be best, or sometimes a limited liability company. So it just depends, you know, who your CPA is and what kind of advice they give you. But this is his advice in his book. Okay, it certainly isn't my advice. Okay. So this all sounds like way too good to be true, right? So what would the pitfalls be? If a client's like, I don't know if I want to invest. What might be some of the pitfalls? Well, there's a lot of myths out there. So investing is complicated. Investing requires knowledge I don't have. Well, hopefully today you have more knowledge. Investing is risky. Yes, it can be, but depending on your level of risk and how you want to invest, we shared that with you earlier. And then we have the truth. Investing is simple when you learn the fundamentals. You're doing that today. Successful investors invest in what they know. So you're learning how to be obviously knowledgeable or more knowledgeable investing by attending seminars like this. And then follow sound investment principles. So that way your risk is minimum. There's other myths. Successful investors time the market. We'll talk about that. All good investments are taken. It's too much work to manage properties. And then the truth, establish clear investment criteria and stick to it. Don't overlook personal reasons for buying and selling, okay? And then leverage property management systems. All right, so you can see the different types of people. You do not want to speculate in investing. So you have the observer. They have no risk, no return, a lot of inaction. Then you have the speculator over here, is high risk, high return. Then you have the collector, low risk, low return. And then you have the investor, minimum risk, maximum return. So who would you like to be on this chart? Anybody have an idea?
Well, I'd like to be the investor.
Sounds like the best option, right? All right, so common investor mistakes, they speculate. Okay, I've got a lot of investor clients that I'm like, no. Didn't run the numbers, insufficient reserves, so they didn't protect themselves with a cushion, and they're unsure how to calculate ROI. So let's help them, teach them how to do these things. And next, we're going to talk about building a team. All right, so this isn't a real estate team. Don't think I'm trying to recruit you if you're listening. Your team should invest in real estate. So that's an agent, right? We have real estate trusted advisors on here that are agents. I happen to be a broker. There's tons of agents and brokers. Lender, you want a lender team. You might want a couple of different options depending on the type of properties. Property manager, I own a property management company, so I'm happy to help you if you do not have that resource. Attorney, I happen to like Ryan Featherstone. Everyone knows that. I'm always bragging. A lot of my agents use Berlin Patent, different attorneys in town. You choose what's best for you. CPA, you can choose a CPA. A very well-known CPA in our town is Joanne Kuntz. A lot of my clients like her, and a lot of real estate agents actually use her too. So I can always send you a list of what I hear good feedback on, or how I hear good feedback on specific advisors with different areas of investing in real estate and different team members, right? So agent, lender, property manager, attorney, CPA. So you have criteria: knowledgeable, best at what they do, and reliable. And you hear that in the community with feedback from your clients, or you have your own experiences as an agent. All right, so as you grow, you can kind of see the list over here. As real estate professionals, you probably already know a lot of this stuff, but your inner circle are consultants, partners, mentors. You always want mentors. And then that support is what we just discussed. And then you've got that service circle. So courthouse clerks. Right now with COVID, we can't go sweet talk them, but you always want to make friends with them. Bring them some cookies. Masons, plumbers, roofers, insurance agents, financial, the list goes on, financial planners, lawn service, carpenter, electrician. So we always have a list of vendors. When you're a new agent and you sign up at our firm, you get a big book like this. And in that book, there is a list of vendors that our agents have great experiences with. So if you don't have anyone, just let us know. We'll get you a list. And then on our team, we even have a smaller list of people we use. All right, so frequency. The inner circle once a month. Those are your partners, consultants, and mentors. So you probably talk to your mentor about once a month. Support circle, every transaction. Your service circle, as needed. Okay, so again, you can see that over here to the left. All right, so how do you confirm your criteria? So how many of you don't know like what to choose? Like how am I gonna know? How am I gonna select this criteria? Who am I gonna ask?
As people that own property.
Yeah. And your mentor, right? Like we just talked about, Austin. Okay, so economic, what can you afford? You got to figure that out. What ROI, cash flow are you looking for? What is the appropriate acquisition strategy based upon your finances? Property type, single family, multifamily. Location, what is your target neighborhood? Condition, how much sweat equity are you willing to put in the property? Features, what are the must-have elements of the home? All right, so this is an example. This could be somebody's criteria: $200 a month net cash flow, buy and hold. 10% below market value and 20% down. Property type, single family, middle class neighborhood in Dallas, Texas. Little to no sweat equity, brick, 3-bedroom, 2-bath. Here would probably most likely be concrete block. We do have some brick homes, but again, this is just an example for a Dallas home. Okay, so this is the slide we had earlier. Acquisition options are buy for cash, find and refer, control and assign, buy and sell, buy, improve and sell, or number 2, buy for cash flow and equity buildup. I like this option, just me personally. I love lease options. I did that with my first commercial building. You can buy and hold, you can buy, improve, and hold. Okay, so I'm going to bring up a hold worksheet. Megan, you like this worksheet. Are you still using this worksheet? She might be on.
Yes, I am. In fact, New Year's weekend, I'm so sorry. Let me put my camera back on.
Okay.
My kitty was up in my face, so.
Hi, kitty.
Anyways, I actually used the investor worksheet for some friends of mine in Ohio. I'm not super familiar with the area, but I walked them through how to use it to figure out which properties were satisfactory for their investment, which is pretty cool.
It's awesome. Yeah, this is a great way to practice. So if you've never used it, I'm going to share my screen with you. Okay. Can you see that okay?
Yes.
Excellent. So if you're an agent on here, you can put your real estate team's logo or your brokerage. So no matter who you're with, you can upload that. I'm happy to share this with you. You can also find it on kellerinc.com under resources for the whole book. And this, you can put your prepared by Bria Moore. I'm happy to evaluate, right, Bria, for your clients. Client name, and then the property address, the list price, fair market value. Okay, you're going to have to learn how to come up with that unless you already know. And then you want to improve that skill. Discount 10%, or if they want a different discount, great. These are just by default in the system. Purchase price, max offer, percent down. This has 25%. You can adjust it to 20 or whatever you want to adjust it to. The interest rate by default in here, this is an older worksheet, it's 6.94%. So you can change that if they're getting a better rate. Rates are great right now. Cost of repairs, they're using 11,000. You might have a different number. Length of mortgage 30. There's also a 15-year hold worksheet you can use, or 15-year. And then it comes up with your monthly mortgage payment, monthly or annual. And then you have rental income. There could be 4 units if it's multifamily, or even more than that. Or it's just 1 unit. It could be a single family home. So you have monthly, annual, and then that comes up with your gross rental income. It does it all for you. This is plug and play. Then you're using a vacancy rate of 5%. You can adjust that should you choose. That comes up with your net rental income. And then you have expenses, and it breaks down what those expenses are. You can kind of look through that. And that comes up with your net operating income. And then you, after your mortgage, your total cash in, down payment plus repairs, it creates your net cash flow. And then what's really cool is it'll do an analysis for you using an appreciation rate of 4.4%. Again, being very conservative. We know we have a higher appreciation right now, but we're talking hold, so it's long-term using conservative amounts. Rent appreciation, people forget about this, of 3.1%. Then cost to sell the property is 7%. How do you think they came up with 7% as a rough estimate?
6% commission and 1% just putting it into the property to make it what it needs to be to sell.
So it's the 6% is kind of a general commission. We all know that's negotiable. So, they're assuming they might have a specific amount that is not a standard commission, but well known of 6%. And then there's a 1% for like doc stamps on the deeds and other kind of costs, maybe an attorney fee, things of that nature. So whatever you think your costs will be, you can come up with, but they're using 7%, and that's where they came up with that. Doesn't mean that's what it'll be, and it doesn't mean that you'll even have a commission at all. Make sense? Now, when you plug all those numbers in, you can actually have some calculations that come through. It doesn't have it now, but years 1 through 30, you'll have all these values across here. So play around with it. Then there's some interest calculations. Again, where it says value, you're going to have some numbers. So play around with it. If you are an agent in my firm, we do what's called a millionaire club every month with the top agents. I'm teaching them how to invest and use some of that money from being a sales associate to becoming an investor so that they can build a higher net worth for their family versus just, oh, how much did you sell this month? That's great. And what are we going to do with that money? How can we help your family more? So we go through these worksheets, we practice with them, and then you'll see these different values populate from this worksheet. We're not going to do that now in essence of time, but I just want to share that with you. Was that helpful? I hope.
Yes.
Great. And there's other worksheets. There's the Millionaire Real Estate Investor worksheet. I'm happy to share all my stuff. I don't want to overwhelm you. I'm just kind of sharing like the ones I like. All right, so let's go back to the PowerPoint and wrap this up so you guys can have a nice evening with your family, ladies and gentlemen. All right. So know which acquisition strategy works for you, your circumstances. You don't own a home or little or no money to invest. You want to buy and live. You have money to invest, looking for cash. You want to buy and sell. You have money to invest and looking to build wealth. This is my favorite. So you want to buy and hold. Okay, so it depends on your client's needs too, right? So practice analyzing deals. We just walked you through how to do that. You've already had this page in the slide, so you'll get more familiar with that. So things to consider, again, deal or no deal. Let the numbers tell the story. Use the whole worksheet. You have criteria, mortgage, rental income, expenses, net operating income, net cash flow, cap rate, cash on cash return, total return on investment. So now that we went through that worksheet and we've gone through this, are some of these concepts and the terminology, is it easier to understand the language of real estate once we've kind of walked through some of this?
Yes.
Great. And hopefully you'll become more familiar with it as you invest yourself. Okay, so these are just some kind of rental values from the past. They've increased a little bit. You can find these on the housing website, the HUD website, different zip codes. You want to get really familiar with your own professional opinion on that, but you can go to HUD's website. Should you want to buy HUD properties, those are kind of the set numbers based on what they come up with their calculations. Lead generate for investment properties. So how do we find investment properties for our investors? How do we find investment properties for ourselves? So networking, this is the number one way where I find properties. I found the Venice office that I own, which is an investment property and does cash flow. I found that through networking, through people. It was not on the market. Leverage existing relationships to find those potential properties. Then you want to prospect. You want to drive target markets looking for sales, vacancies, and unkept properties. You can drive around. You can find for sale by owners. You can find foreclosures or people that might have to do a short sell. Market. Comprise a campaign, including flyers, online, and print ads to spread your message. You can do social media advertising. What else could you do? What would be another idea?
I hate them, but a lot of people send out letters that basically say, hey, I'm looking to buy, or you looking to sell, to a lot of owners on people who's owned houses for a while or in ran down neighborhoods and things like that.
Yeah, absolutely. I get letters all the time on some of my actual investment properties. You can do seminars like this, right? You have friends and family, neighborhood associations, business colleagues, community events. I know we're limited on those right now. Hopefully that'll change. Real estate agents, lenders, attorneys, real estate investment clubs. There's a ton of those in town. Lead generate for properties, listings, vacancies, for sale by owners, pre-foreclosures, foreclosures. For sale by owners are great. And as an agent, I have to disclose that I am very much an investor and I may or may not be interested in buying their property. And I'm happy to make them an offer should they not want to take the traditional route and list, but it has to meet my criteria. So that's also a listing tool. You can get in front of people and figure out, hey, do I want to buy it, or do they want to put it on the traditional market and try and generate a little bit higher price? Just kind of depends. Do they want a quick offer or not? You can create billboards or yard signs. Like Austin said, you can do direct mail. We all love receiving direct mail, right? But it does work, I promise you. Then you can do radio or TV ads. Some people are just really going to social media. It's more cost effective since they created this PowerPoint. I prefer that. It's a lot easier. And then we're just going to talk about financing real quick. If you're an agent, on here, we'll cruise through this, but there are some steps involved in financing and purchasing in the transaction process. So you want to arrange financing. You want to write a bulletproof offer. An agent can help you do that. Negotiate a win-win transaction. Everybody feels good. So a conventional loan would be an option. It's a lending agreement not insured by the federal government. Okay, so we're not talking FHA. 2, know the difference between conforming and versus non-conforming loans. Understand conventional loan criteria, what PMI is, owner-occupied financing, number of investment properties owned, previous landlord experience, and cash reserves. So those are some of the loan criteria that they'll need. Then there's private financing. So we have syndications, local banks, hard money lenders, and partnerships. Those are all your private financing. So what about creative financing? Owner financing, assumptions. Some people might want to do owner financing for you or let you assume their loan, wraps, lease options, or private seconds. Okay, always get a real estate attorney. And let me go back to this other slide. I should disclose you should always talk to a real estate attorney about private financing as well. I'm a real estate broker and I always have an attorney when I do those creative or private financing options. So with conventional, how much would your PMI be if I'm securing owner occupied financing and putting less than 20% down? These are questions that you want to ask your financing advisor. How long is the term of the occupancy for owner occupied financing? Because you might have to occupy it for a minute. What is the current limit on number of properties for a conforming loan? And that's why you might want to use private financing depending on the limitations here. I would like to use the rental income from this investment prospect to qualify for the mortgage. Do I need to have previous landlord experience? These are all great questions. How much cash reserves do I need to set aside for the investment prospect? Private financing. What recommendations do you have to help me find investor partners for real estate investing? How do I find out which local banks specialize in real estate investment lending? Is owner financing an option for this deal? Do you have a partnership agreement I could use? Move this out so I can see this to help me negotiate. Okay. And oops, sorry about that. Terms of the partnership on this deal. So a lot of times people have partnership agreements. I like using an attorney. These are great questions to ask your financing advisor. Okay, so whoever that might be. And then you have strategies for a bulletproof offer. I always say just get a great agent. Hopefully you choose myself or someone on my team. I'm happy to refer you to. But how much equity does the seller have? Why is the seller moving? They can help you with this. What terms will they accept? Name a competitive price. You want to practice doing a comparative market analysis if you're an agent over and over again until you master this, or partner with an experienced agent like myself or someone on my team. What are comparable properties selling for? Compare prices and quality of other properties with your property of interest. Know your terms. What requests can you make of a seller to sweeten the deal without lowering the purchase price? Maybe it's a home warranty, contribution to closing costs, etc. Exercise caution with contingencies. All right, so finance and buy. So negotiate everything: price, financing costs, closing costs, possession date, conveyances, ability to rent prior to closing, ability to start repairs before closing, and ability to sign the contract. So these are all things you can negotiate. Then you want to manage like a pro. I definitely recommend hiring a property management company because they'll help set the rent. They know the comps. Don't try to do that yourself if you don't have experience in property management. They'll help you promote your property on social media, yard signs, online rental websites, social media. There's all these online rental sites that as an agent that only does sales, you might not be aware of. Show and lease the property. They'll do that for you. They'll make sure the property's neat. They'll do the key exchange, talk about the amenities. They'll talk about the major repairs that might be needed that you need to do before you actually show the property. They'll help manage and negotiate those repairs with a company. I also own a repair and remodel company, so we're happy to help you with that, coordinate that through our management company and that remodel and repair company. Then they'll screen the tenants, run a credit check, FBI background check, rental history check, employment check. They'll do all that for you, all those headaches, and find you a great tenant or more than one. These are all the steps that the tenant leads will need to go through with a property management company. It's a lot of steps. So you certainly want to take a look at this, take a screenshot, make sure you understand the process and how a property manager can help you. If you do it on your own, you're going to have a lot of time on your hands, especially with all the applications you'll receive right now. Establish systems for property maintenance and repairs. Again, we have companies that can help you do this, and they'll coordinate that with the tenant, the property management company will. And then when the tenant moves out, there's a lot of steps. These are all the steps that are necessary when they move out, okay? Lots of paperwork to sign. They'll also increase gross rental income, control your expenses, and minimize your vacancies. There's also all these wonderful depreciation operating expenses, things that will maximize your deductions we've kind of already talked about. And then lease option out, refinance, tax deferred, 1031 exchange, and sell. Okay, so there's all these different things that you want to be mindful of. I have lots of blogs I'll show you here in a minute to walk you through attorney written information about 1031 exchanges. Then you have buy fixer-uppers and make improvements, invest out of state and strong areas. That might be something you consider or not consider. Most people live close to their properties. However, I did interview a good friend of mine, Catherine Rain, yesterday. She has 8 properties out of state, all in mountain regions. They're cabins that she's fixed up, and she's doing great with them. So it just depends. You need to go there, investigate, find an expert in the area. You can buy foreclosure short sales, buy investments with a self-directed IRA. You can turn necessary expenses into gains. You can tap into your equity, and you can repurpose your existing properties. Okay, so again, I own a property management company. These are some of our services. It's Florida Suncoast Property Management. I will have the contact information up here in a minute. We can also recommend other companies to interview. We do seasonal and annual. I like annual. It's up to you if you like the seasonal. Obviously, you'll get a little higher, but it might not be as consistent as far as the tenant paying on a monthly basis. And here's Tiffany Richmond's information. We do have an office in Northport. That's primarily where she offices out of. We do have quite the territory that we cover as far as the properties that we manage. We like to stage our seasonal properties. So our staging company is C&J Staging and Design. Talks about, why you want to stage. We have some National Association of Realtors statistics you can look up. Why people buy or rent properties that are furnished. Okay, you can partial or fully stage them. We already talked about power of leverage, so we'll kind of skip through this. I think you're good on tax write-offs. So these are just some statistics. Bria on our team, who's also on here, is our marketing director. She's also a licensed sales associate, so she can certainly help you with any of your investments. But she posts a lot of these blogs for us, and here's some local statistics. Okay, so if you're wondering what the market's doing, these are from December. On January 22nd, the new statistics will be out, so we will have those posted. She'll be happy to send those to you and discuss them with you. So this is Sarasota County. So what do you think that average price point has done? Has that gone up lately since November of 2019? Quite a bit, huh?
More than 6%.
Yeah, right. So, yeah, right. More than 5%. So I thought this would be pretty eye-opening for you to see. You can see percentage change year over year was 32.1%. I will be very curious to see the new numbers come out, right? So the average price was $541,339. The median you can see was 350, which is above the national average. Hopefully you know those numbers as experts. And then you can see the inventory. What's going on with the inventory?
Very low right now.
1.8, right? It's showing you. And it says that's down 50%. It was 3.6 months before. So year over year percentage change. Okay, so let's go back to the PowerPoint and we'll Oops, it's not what I meant to do. Okay. Can you see it now?
Yes.
Awesome. All right. These are just some National Association Realtor statistics. You can look this up. Personal financial characteristics of buyers, what they like to buy, primary residence versus vacation properties, investment properties. They come up with these studies all the time. You can see a lot of it's vacation and investment properties. Okay. So these are their rental expectations for short term. Again, it's all on their site. I'm not going to bore you with too much of it, but we're happy to get you some of this information if you'd like to inquire about investing. You can see here the amount of people that finance, okay, versus paying cash. Location of properties. A lot of people like Florida. They like single family homes. They like condos too, but you can see detached single family homes are most popular for all different types, primary, vacation, and investment. So that's why I like investing in single family homes if I do residential. I do like commercial. So look at this location of properties. Most people want beach or lakefront. So we have an advantage, right, of owning or selling these investment properties in our area because we have the #1 beach according to TripAdvisor. These are some other statistics. Again, you can kind of look this up on your site here. This is the population growth. So people say, why should I own property where you live, Brandy? Well, I don't know. Let's see. Do you see anything that stands out about our population growth lately? Got Northport, Sarasota, Bradenton, percentage increase, right? The percentage change was 18%. We ranked 20 in the nation for population growth, fastest growing metropolitan areas over here. Then you can see employment. Look at Florida, 22.4%. Population growth, we're second next to Texas, but Texas, 27% of people that moved during COVID into Florida were from Texas. So you might see this shift when we get the new numbers. And you can see that here on this particular website. This is the National Association of Realtors. Okay, so this is where are people moving during COVID? Where are they going? There's a lot of information on here. So you can drop down and you can say, okay, who's moving into Florida? 27.8% of the people during COVID, the inflow came from Texas. Next was New York. New Jersey, I can tell you, is 100% legitimate because I just had a client here this afternoon coming from New Jersey, Massachusetts, and Michigan. All right, so we'll go back to some other cool links. Happy to send these to you. How money walks. I always share this with everyone I know, especially the agents I'm training. So you can click on Florida and go, oh, whether you sell in Manatee or Sarasota, we primarily do Sarasota. Look at this. So
You can't see it if you click on it.
Oh, you can't? Okay. So let me reshare. Can you see it now?
Yes.
Awesome. Okay. So you can see we gained wealth in 2019. We'll see the new reports come out, but Cook County, 381.50 million. Okay, that's the wealth we gained from Cook County into Sarasota. Oakland County, Michigan, Fairfield County, Connecticut. I'm sure this is where all your clients are coming from if you're real estate professionals. Westchester County, New York. We've always had, I have friends that have actually moved from there. Fairfax County, Virginia. So hopefully that helps. And then I got one more I'll show you. So this is realtor.com. This shows you the views online. Okay, you can go on here and you can kind of see who's viewing what. And you can click on your county. So won't bore you too much with it. You're welcome to go to that link, but it's nice to see who's viewing because that might be who's coming soon. It's good to know who to market your listings to. So why Florida real estate? This was a really cool article on rented.com. It was just saying that, you know, where we ranked and top 5, these are different places. There's Florida was on there with Panama City Beach, Palm Coast. So maybe those are areas you want to invest in. And then Tennessee, that's where Catherine is actually buying some of her properties. And then I have a blog on 1031 exchange. So if you're not familiar with 1031 exchanges, I'm happy to send this to you. It's on one of my property management sites. It's also on my website, but I'm happy to send you the link so you can read about it. And then, as Megan mentioned, there's a lot of opportunity funds. This is a discussion topic in Sarasota. There's a link that I can send you where you can find the opportunity zones, all right? And you can look at that and see why that's beneficial for you as an investor. And then again, this is all the wealth that we've gained with migration patterns. You see it every year. We're always gaining. You can kind of see different patterns. Won't bore you with all the articles, but I'm happy to send it to you. So any key takeaways? We're at the end of I tried to get as much of it in as possible. It's a long seminar, but lots of good information. So what are your takeaways?
My key takeaway is that 15% of income, setting it aside for investing and having that separate investment account. So
love it.
Just a really good reminder.
Yeah, we forget, right? We get in this day to day and we're out there selling homes, or if you have another type of job, right? You're in your job, you're working, you come home, you make dinner, you might have children to run around, and we forget to take those funds that we're making, no matter where they're coming from, and allocate that 15%. If you're a real estate professional, you have a great opportunity to take it from each commission check, right? So key takeaways should be: know why you're investing, track your net worth, analyze many properties, join your local investor association. And if you're an investor on here, obviously hire a great agent, hire a great attorney, hire a great CPA. So here's some resources. Millionaire Real Estate Investor, the whole book. I can send this to you. My contact information is super easy. It's Brandy Coffey, BRANDY COFFEY at thecoffeegroup.com. And you can reach me on our team line at 941-404-4737. We're happy to set up a consultation with one of our trusted advisors. We do have a strong team ready to help you. And we also, my cell phone, if you need to text me, which is my preferred method of communication, 941-284-4474. That's a real quick way to catch me. I am happy to send you some of these worksheets or where to find them. And so for all of you that have attended, I am going to pick one person, and I don't know the order in which the screen's laid out. So I'm just gonna kind of say the last person that's on my screen when I put it to gallery view, you are going to get a copy of the Millionaire Real Estate Investor. So let's see who that is when I open up my screen for attending. All right. Well, I don't know who LA is. They just have initials, but I'm happy to send you a Millionaire Real Estate Investor book, should you not already have a copy of that. So if you'd like to come off mute or put your information in chat, we would be happy to send you the book for attending.
Hi, Brandy. Thanks so much. Yes, I will definitely love a copy.
Okay, awesome. So you're welcome to contact me directly or put your information in the chat if you'd like, and I will mail you a copy.
Will do. Thank you.
Fantastic. All right. So if anyone wants to name 5 ahas before we go, I will give you a copy of the whole book, since we have about 12 minutes left. Who wants to go? 5 ahas. Come on, you have to have some ahas. Anybody want to read the whole book?
I already have the whole book, or I would give you my ahas.
Let's let someone else get a book. No one wants to read it? Austin, you're on mute. You want to read it?
Sure. I mean, my aha definitely for me, I guess would be definitely the budget stuff because anybody that knows me, I tend to spend more than I should on occasion, um, especially on things that I normally don't need.
Yeah.
I'm bad about that. Um, I really did like the spreadsheets that you showed, especially about the breakdowns. Those spreadsheets would have definitely came in handy with me in the past. Um, a lot of the calculations I know how to do, but it really makes it easy to be able to give someone a spreadsheet that'll calculate it for them.
Yeah.
Because there's a lot that goes into calculating, your ROI when it comes to these properties. Because there's a lot of little expenses that people just don't think about.
Yeah. They
Um,
forget, don't they?
yeah, so that definitely is pretty interesting. I did have a question for you though.
Sure.
You kept mentioning, that you like to purchase commercial real estate. Are you worried about purchasing commercial with like the times, everything kind of shifting to working from home and a lot of vacancies in commercial right now?
For me, I'm very specific about what I like. So commercial to me, that's fun, I guess, is something that maybe I can occupy one of my businesses in and rent out the rest. So it's paying my mortgage. I get some free office space. And the tenants pay my mortgage down. And then I've also got cash flow. So, and I look at it this way, one of my client actually asked me this today. He's like, aren't you worried about, owning this or that? And I said, I'm not really big on owning retail spaces. I think it's great that you can make a lot of money in those, but look what's happening right now. So yes, you have the maximum return sometimes, right? You might have like a really nice profit, but you might lose a little bit too when something like this happens. And then what if they're all vacant? So for me, I like kind of small, medium-sized commercial buildings that if all else fails, right? Let's just say real estate agents don't exist anymore, which a lot of people may or may not believe will happen. But look, Zillow is a brokerage, right? So if we don't start showing more value and becoming more educated, this is why I always preach on training, and I love learning. So I will always continue to educate myself. But if other agents do not do what we do, right? We're all on this investment seminar. We want to learn more, and we never know enough. If you think you know everything, you never will. That's never going to happen in real estate. Every day you're going to learn. But if you don't invest in yourself to invest in your client, which means learn to educate them and be on top of every little thing that comes out, right? There's always new tax benefits. There's always a new opportunity zone. There's always another area that's up and coming. If we don't create more value for our clients, then real estate agents might cease to exist, or there's going to be a huge void of the single agents that are fiduciaries that learn how to really be a consultant and advise them at a high level. And then they'll be like the flat fees, right? Those medium-sized transactional brokers will disappear because they just want the duty to the transaction. So if all else fails, Austin, and let's just say real estate agents cease to exist, and let's say Venice, my commercial building in Venice, is no longer a Keller Williams franchise. I don't think that'll ever happen because we have the best education and training. We're the #1 training company in the world, even outside of real estate. But let's just say worst case scenario, I know for a fact that I can take this building on Venice Island, which is on the main drag to the beach, with the #1 restaurant and bar in the state of Florida, Sharky's and Finn. We always are going to have people coming to the beach that are going to want to eat and drink, right? And visit Florida and a resort and second home market. I could rent this building to an attorney. People always need attorneys, or a doctor like that. We always need physicians, right? How many doctors do we need right now?
Yeah.
So that's my opinion. I'm not saying I'm making the most money, and I'm not saying I know it all. It's my preference on what I like to invest in because it seems safe to me and it's cash flowing. It's just a good fit for me.
That's what matters.
Yeah, makes me happy. So I just love to share with others whatever they like to invest in. I have clients that like to invest in things that I don't. I still advise them and tell them what I think, and I break the numbers down for them and tell them it's my opinion. and that they also need to have a CPA and an attorney, just like that team we talked about, right? So, all right, Austin, you get the whole book, and I'll get everything else out to everyone else. Have a great evening. I hope you have a wonderful evening with your family.
Thanks, Brandy.
My pleasure. Talk to you
Thank
soon.
you.
Bye, Bria.